Let's wait for a few seconds so that the participants can join in. Okay. Good evening, ladies and gentlemen. Welcome to the next webinar of MeritorQ Advisory Portfolio. I'm Alok Nangalia and I'm part of the Client Advisory and Relationships team. I have with me Krishnan, who heads the research function for our quant offering, MeritorQ. At the outset, we have always outlined that the rules in MeritorQ will evolve based on our research, and we will continue to enhance the rules if we find that the changes improve risk-adjusted returns for our investors. In continuation of this principle, we recently moved to quarterly rebalancing schedule from semi-annual rebalancing earlier. We believe that this change in rebalancing schedule will improve risk-adjusted returns for investors going forward, while sticking to the Meritor's core investment objectives of buying clean companies, profitable and undervalued companies in a systematic and rule-based manner. As usual, once Krishnan completes the presentation, we will have the Q&A session. You can type in your questions in the box on your screen during the course of this webinar, and we will try and answer as many as possible post the presentation. With this, I request Krishnan to take us through the presentation. Over to you, Krishnan.
Thank you, Alok. I'll just share my deck. Just give me a minute. Okay, I hope the presentation is visible.
Yes, it's visible.
Okay. So again, thank you, everyone. Good evening. Again, welcome to another webinar of MeritorQ. A very happy New Year to everyone who has dialed into this this call. Hope you have a very joyful and successful New Year 2024. So just at a turn of this start of this year, we decided to change the rebalancing schedule in MeritorQ to a quarterly rebalancing frequency. And with that, we had our first quarterly rebalancing on 1st of January 2024. So before that, I'm sure people who had subscribed to this portfolio, you would have got a note from us, to be prepared to do the rebalancing on small case. So so what we will do in this webinar is firstly, to give you an idea of why what was the rationale to do for this methodology change, right? Why did we change from a semi-annual rebalancing to a quarterly rebalancing schedule? And then we'll also walk you through some broad portfolio level characteristics of the new rebalanced portfolio, which went live on 1st of January. So with that, just some of these disclaimers. Please do note that investment securities market are subject to market risk, and you should read all scheme-related documents carefully before investing. And all figures presented on this presentation are for your illustration and understanding only, and do not guarantee any future returns. So with that, right? What's a change and what's the rationale for the change, right? So the change is essentially what Alok mentioned, that we have now changed the rebalancing frequency to quarterly. So it will happen 4 times in a year. The first rebalancing was put into effect, like I said, on 1st of January 2024, and subsequent rebalancings this year will happen on first trading date of April, July, and October. So earlier, when we till last year, we had done this twice in a year, as of the first trading date of April and October. Now it will be January, April, July, and October. So 4 times in a year, you will have to rebalance the portfolio, basis and obviously you'll get the notification from small case and even from us, just to remind you to complete the rebalance. And all the portfolio construction steps in MeritorQ, again, whatever we have discussed till date, will be applied at each of the each of these four quarterly rebalances, right? Additionally, what we have also decided is, we have, the construction rules will now ensure that the allocation to a single stock in the portfolio does not exceed 15% at the time of rebalance, right? So again, this was, something we had observed, basis, what we saw in the portfolio last year. And we thought this was a prudential, action to take, just from a risk management perspective, so that investors are not caught with an excessive concentrated position in a single stock. So why did we make this change, right? So the key reason is we have always said, right? So if you think about how we capture alpha in MeritorQ, uh, the key step is the rebalancing, right? So we are buying undervalued, good quality undervalued companies, clean, profitable undervalued companies, and then we hold them for at least a year, and we wait for these companies to revert back to their fair value. And as soon as they revert back to their fair value, we essentially refresh the portfolio, right? So we allow the next set of undervalued companies to come in, and the companies which have kind of reverted back to the fair value, there we just get rid of them, right? So if you think about it, that's the one of the key drivers of how we are capturing alpha, and how it's working towards enhancing your returns for investors, right, in this strategy. Now, if you actually think about it, there is no reason to say that we should just be picking up these undervalued stocks just twice in it, right? Just in April and October, right? We can do it as often as possible, but the problem is churn, right? So and earlier, what we had, the rationale we had discussed was, we had obviously looked at this trade-off between churn and reducing this timing risk or picking up undervalued stocks regularly, and we felt that semi-annual rebalancing give us the best trade-off. But now, basis some of the changes obviously we have made over last year in the rules, and some of these changes obviously are some of them are small, some of them are relatively large in terms of the impact. But things again we don't discuss with investors in public for obvious reasons. But what we see now is given these changes we have made, and also because when we look at this portfolio today, the strategy today, what we see is quarterly rebalancing gives us now the best trade-off, right? And we'll discuss the numbers, basis the back test, what we see, and which kind of also was one of the reasons we took the step, right? So and we'll go through some of this, the other rationale, regarding this timing risk and what we mean by timing risk, and how this quarterly rebalancing allows you to reduce the timing risk, in the subsequent slides. Now, in terms of the other advantages, obviously it makes execution easier for someone who is invested through small case, and a simple reason for that is if you are rebalancing on on any particular date, I'm sure most of you would be aware, who are subscribed to this portfolio, that you'll not be able to buy, you'll not be able to buy your all the stocks, all the fresh buys with your sell proceeds, right? So 100% cannot be used. So only because of SEBI's margin rules, only say 80 to depending on your broker, 80 to 50% of the sell proceeds can be used for buying, right? Now with this change, because now your turnover will basically be spread out over 4 rebalancings. So the requirement for you to top up to execute your rebalance successfully, on a single day at the time of rebalance, that requirement of funds will come down, right? And that's simply almost like a byproduct of the way we are doing this rebalancing. We are basically spreading out the turnover in some ways over 4 dates instead of 2 dates earlier, right? So in that way, I think that's useful for in terms of making the execution easier, or the rebalancing easier on small case, right? And obviously, one of the reasons, right, why we even shifted to this quarterly rebalancing was also this the stock concentration, single stock concentration, which we saw. Now, because of the quarterly rebalancing, we'll be anchoring back the allocation towards individual stocks back to the the model weights, as of every quarter end. So, the chances of any stock, kind of exceeding or, becoming, too much, too large in terms of your portfolio allocation, that chance or probability will come down, right? Versus what was happening earlier. And obviously, things like, for example, all the fundamental checks we were doing, right? The forensics, the consistency and leverage, all those screening steps as well as selection steps, all the hygiene checks, right? Especially even the corporate governance check, all those checks will now be done quarterly, right? So, if you have a bad apple in the portfolio, what this means is, with this quarterly, rebalancing, there's a higher chance that you will be able to get rid of the bad apple in the portfolio, or a bad company in your portfolio sooner rather than later than what we were doing earlier, right? So these are some of the advantages, again, or the reasons we basically saw for shifting to this quarterly rebalancing frequency from semi-annual. And obviously, for people who have subscribed to our fixed fee option on small case, for them, this rebalancing frequency would be nicely harmonized with their fee payment schedule, again, which could also be, you can say, would be convenient in some ways. Now, coming back to our, the portfolio construction steps, nothing has changed here, just to emphasize, right? So, this is all the steps we have, kind of, talked about till date. We start from, BSE 500, which is, our investment universe. From that, we remove all companies, which are, roughly around 200 companies, per our forensic screen. Essentially, all companies falling in so-called zone of thuggery, right? So the bottom 4 deciles in terms of all those 11 ratios which we use to classify companies, whether the company is distorting or hooking its books or not, or distorting its accounting picture or not, right? So that's the first step, the forensic step, and then we have 2 more screens: basis leverage as well as consistency of profitability. And after these screens, we are left with roughly around 80 to 100 companies. From the 500 odd companies in the investment universe, we bring it down to almost 80 to 100 companies. And within this, we are looking for companies which are both undervalued as well as profitable, right? So, this balance between undervalued and profitability is key. And we have always said that, this is, one of the key reasons, key differentiators for MeritorQ, right? We are not looking for only undervalued companies or, only quality companies. Ideally, we're looking for companies which give us a balance between these two. Essentially, the selection step, we are selecting around 30 to 45 companies which have this balance. And position sizing, again, is done in a way so that, companies which are more undervalued, they get a higher allocation in the final portfolio. And now we do this, all these steps quarterly instead of semi-annually. And also in the last step, if you remember, we have a corporate governance check where the Marcellus team looks at the final portfolio and we find, if there are certain stocks, which don't, which we as a firm, we are not comfortable with. These could be corporate governance or, issues with promoter integrity, right? Where, which cannot be strictly be quantified. So in those cases, we manually remove those stocks and redistribute the weight of these stocks pro rata, across the portfolio. Now, essentially what we are saying now is there are no changes in these steps, the portfolio construction steps. Instead of doing, all these, sequence of steps twice in a year, as of April and October, now we are proposing to do this 4 times in a year in January, April, October, and July. So, coming to this, the numbers. So, what you see on the slide is, essentially we, the reason why we are, we went with this change. And so we backtested, all the rules, right, using with the semi-annual rebalancing frequency as well as a quarterly rebalancing frequency. The semi-annual rebalancing frequency, the numbers for those is on the first column here on this slide, and the quarterly rebalancing is the second column. So, and this entire simulation was done on, again, point-in-time data, again using the same, for the same investment universe and using the same sequence of steps which I saw in the last slide. And we have done this over almost a 17-year period, July 2006 to November 2023, in fact. And this is what you see here. And what you see is When you compare the risk-adjusted returns, though it's not shown here, it improves slightly with quarterly rebalancing. The risk as well as things like downside risk, max drawdown, and even the drawdown. If you remove COVID and GFC, all those are lower with a quarterly rebalancing versus a semi-annual rebalancing, right? In fact, the downside risk, right, which is some might argue is like the real measure of risk for any strategy, that's almost down by half a percentage point. Max drawdown is down by around 5.2 percentage points, and the drawdown excluding COVID and GFC. So the max drawdown number here is essentially from the global financial crisis period. So if you remove COVID and GFC, which were the two largest kind of risk off events over the last 17 years, even if you remove those two events, this quarterly rebalancing still would have given you an improvement in your drawdown, even for some of the mini drawdowns that would have happened during the period. So that number is down by roughly around 1.4 percentage points, right? And over this, the cost when you compare. So this is in terms of your reduction in risk and improvement in risk-adjusted return, but in terms of cost, which is a turnover, right? The churn. So what we see is there is the turnover increases, but doesn't the change is almost immaterial, right? So it goes up from 58.8 to 58.2 to 58.8, and remember this is one-way turnover. When we say one-way turnover, essentially this is the change both in terms of your the churn, the stocks either entering or exiting the portfolio, and also the change in terms of weightages, right? So either you're selling up, you're upweighting or downweighting stocks, right? So it includes both, right? So it includes changes in weights as well as the churn. Churn, what we see is the churn is broadly similar to what you had with semi-annual rebalancing, roughly around 47-48%. And rest of this, the delta which you see, the increase is due to the change in the weightages. And there is hardly any difference in terms of the one-way turnover between quarterly and semi-annual rebalance, right? So this is what kind of drove our decision, right? So the cost doesn't increase, a lot. In fact, it doesn't increase materially, whereas your risk-adjusted return does increase. So why not go with this change, right? And also, if you have any questions on, for example, does your number of stocks in your portfolio will increase? Uh, the stocks in the portfolio will still stay within the range which we have discussed before, between 30 to 45, right? We don't expect it to cross, that range. So it should still stay, within that range. And also, like I said, right? So this, the first rebalancing, went into effect in 1st January, and this year we will have 3 more rebalancings, and subsequent years again we will follow the same cadence. So this again, we are trying to tell you again how with this with the quarterly rebalancing, how it compares to semi-annual rebalancing in terms of how the turnover gets spread out. So the blue line is the turnover at every rebalancing for a semi-annual rebalance portfolio. The red line is the turnover for a quarterly rebalance portfolio. So the red line you can see is consistently below the blue line, simply because now instead of incurring say a 30% turnover, roughly a 30%, or in this case a 29.8% turnover, which we have represented with a dotted blue line, at every twice in a year, right? So roughly that means around 60% for annualized. Now you are incurring around 15%, right? Turnover at every quarter, right? So instead of incurring a 30% turnover at April and October, now you are incurring 15% turnover in January, April, October, and July, right? So again, the overall turnover still is in the same ballpark, right? In fact, the change or the increase is immaterial. But what you have done is just spread out that turnover over 4 dates instead of just 1 date, and obviously that helps you in terms of execution. And in many cases, right, especially if you have a large enough investment, and especially if there are illiquid stocks in the portfolio, or small caps in the portfolio, it helps you to reduce the market impact, right? Because your turnover would be spread out, and you will not be trading a very large amount of the stocks at any given rebalance date, right? So that's also a benefit in terms of your overall returns which you will realize in this strategy. Now, coming to this aspect of timing risk, and why picking undervalued stocks regularly is important. So I don't need to again emphasize that aspect. I think we have explained enough, right? Why picking undervalued stocks and rebalancing often helps in MeritorQ. But when you look at the drawdowns in BSE 500, right, and we have given a very broad picture here. So you can see here, we are showing three lines, and the blue line is the drawdown of for the BSE large cap, which is your top 100 company by market cap. The yellow line is your the drawdown chart for your BSE small cap index, which is your bottom 250 companies. And the red line is for BSE 500, which is somewhere in between, right? Because it includes both large and small caps, right? Now, what you can see obviously is small caps obviously have larger drawdowns, and that's no surprise that they're more volatile, smaller companies. So, if you take, for example, the largest drawdown, which all these indexes would have seen over the last 16, 17 years would be during the global financial crisis around 2008, right? And if you remove that, the next biggest drawdown would be, at least for large caps and BSE 500, would be during the Corona period, right? March 2020, right? Now, why is this important? Because if you now, just take this chart, right, and look at all the instances where BSE 500, right? BSE 500 as an index, because that's our investment universe in MeritorQ. You look at all the instances where the BSE 500 had a drawdown of more than 10%, right? So this slide kind of shows you all those instances. So there are 14 such instances which we find over the last 16 odd years, right? From July 2006 to November 2023. And what you find is, what we're showing you on this chart also is, in each of those 14 instances, what was the extent of the drawdown, right? Which you see in the the columns in the middle, the returns during the recovery phase. So there is a drawdown, and then obviously there is a recovery phase. So you see both the drawdown, the extent of the drawdown, as well as the recovery after the drawdown, right? And then we also see the peak to trough duration, the duration of the drawdown as such, and also the duration in terms of days of the over which the recovery also happened, right? The point again to emphasize here is, there are drawdowns, right? Mini drawdowns essentially. Essentially where BSE 500 had a a drawdown where the drawdown itself lasted less than even 1 or 2 months, right? And the subsequent recovery also happened and within 1 or 2 months, right? So the entire drawdown as well as the recovery happens in less than 6 months, right? So, one classic case, is in fact the last row, right? The most recent case, which was between December 2022 to March 2023, right? Which is the last row on this slide. You can see the BSE 500, roughly fell around 11.3% during this period, right? And that whole episode lasted around 117 days, right? And from March 2023 onwards, from April last year, the recovery started, and within 78 days, the index was back to where it was, right? Now, if you compare our current quarterly rebalancing versus what we were doing earlier, semi-annual, we would have had just one rebalancing, right, between December 22 to March 2023, right? We would have only done a rebalancing in March 2023, right? But if you think about what we are doing now, we would be doing two rebalancings, right? So we'll be doing one rebalancing in December and also in March. So there is a higher probability of catching these kind of mini drawdowns more often, i.e., you'll be picking up undervalued stocks, or your chance of picking up undervalued stocks that increases, right? And also because like you always said, right, the more is your chance of picking undervalued stocks, the more frequently you rebalance, the higher chance you have of improving your risk adjusted return, right? And also, there is a fair amount of allocation towards small and mid caps in this portfolio. And small caps in general, if you have them in the portfolio, they do experience larger drawdowns. In fact, more than 50% drawdown in a 6-month interval is par for the course for a small cap stock. So to the extent it's it clears all our filters, and we are able to pick up these companies more regularly through a quarterly rebalancing schedule. That's also an additional reason for us to shift to a quarterly rebalancing schedule from semi-annual. Now, again, this slide, again, we are explaining, again, what we are trying to show is this, the drawdown for the semi-annual rebalancing strategy versus a quarterly rebalanced one. And you can see, again, this is basically, the numbers which we have summarized in this chart, right? So, the numbers which we discussed here is, the chart here. And you can see that the quarterly rebalanced strategy, which is your yellow line, is almost always has a better or a lower drawdown versus the semi-annual rebalanced one, which is represented with your red line. Now, coming to the portfolio stats, again, just some broad portfolio characteristics of the portfolio which we rebalanced or went live with on 1st of January. This portfolio has around 41 stocks. In terms of the allocation to top 5 or the top 10, there's not much change. It's still around 32% and 52% respectively, 51, 52% respectively. Also, in terms of if you think about profitability, it broadly compares well with the previous portfolio. So not much change there either. The earnings yield has come down slightly, but remember what we are focused in MeritorQ is price to free cash flow essentially, or the inverse of it, with this free cash flow yield, right? So higher the free cash flow yield, lower the price to free cash flow of the portfolio, and because that's the focus for us in MeritorQ, we want that to be as high as possible, right? So you can see here the free cash flow yield for the portfolio is around 3.2% after the rebalancing, which is slightly better than the last portfolio, which has increased from 2.9%, and it's also compares favorably versus 2.3% for the benchmark BSE 500 equal weighted. The dividend yield is again comparable, 1.4% with the previous portfolio as well as the benchmark. Now, coming to the the sector distribution as well as the size distribution for this portfolio. In terms of sector, the strategy remains overweight the consumer discretionary, IT, healthcare, and utilities. Allocation towards financial stocks in this portfolio, in the most recent portfolio, has increased to 7.4%. And in fact, 2 lenders have been added to the portfolio. And again, this is not very surprising, right, for people, especially for folks among you who follow the markets. This obviously the valuation aspect, especially valuations of some of the private banks, have become attractive given their relative underperformance in 2023. So that's it in terms of sector distribution. In terms of your distribution towards large, mid, and small caps, the most recent rebalance portfolio has a 33% allocation towards large caps, and a 44% towards small caps and rest towards mid caps, right? Allocation towards large caps has gone up progressively, right, over the last rebalancing and even the rebalancing before that in September. So in fact, if you look at the large cap allocations over the last 2 rebalancing, it has gone up from 24% to roughly around 34%, which you see, or towards 33%, what you see now, right? And conversely, allocation towards small caps has gone down the other way, from 59% before the September rebalancing to around 44% now, right? And again, we should not be too surprised here, given that in 2023, the BSE small cap 250 and the BSE mid cap 150 were up 44% and 40% respectively. So there was a lot of it was a very good run for small and mid caps last year. And this is also in fact, this highlights one of the aspects which we have almost always highlighted in MeritorQ. In fact, something we emphasized at the time of launch, that because of the all cap universe, right, in MeritorQ, and because of the valuation focus, this shift across market caps to the extent that good companies are available at at attractive valuations, in different parts of the market, they will automatically reflect in the portfolio, right? So to the extent that, for example, you have higher chance of picking up more undervalued companies today in large caps, versus small and mid caps, that will be reflected in the portfolio. But remember that again, we don't have any constraint on large, mid, and small cap allocations. It's basically a result of the number of undervalued companies or undervalued opportunities we get, right? Obviously, with all those quality screens we have. So, again, that's the kind of the brief summary, or where the portfolio is, how it looks like. And obviously we'll continue to look for opportunities to improve the portfolio rules like we've always done, and given again, first of all, they should improve your risk adjusted returns going forward, and should make sense, given our forward view of the markets. And throughout, if at all we make any changes, we will always adhere to the MeritorQ's core investment objective of buying clean, undervalued, and profitable companies in a systematic, rules-based manner. So with that, I'll conclude today's prepared remarks. Over to you, Alok.
Thanks, Krishnan. We already have a few questions in the box. So anybody who wants to put in their questions, ask any questions to Krishnan or have any queries, please drop in your questions in the Q&A box, and we will take this one by one. So some of the questions which have come in, you have already asked, you have already answered. For example, why are we shifting to quarterly rebalancing? Initially, we maintained that we will be doing it only twice a year. Also, will it increase my churn? Whether it will increase my transaction costs? So this you have already answered that there is a slight advantage of shifting to quarterly rebalancing. There is no disadvantage as such. And what we are doing is we are breaking the transactions into 4 tranches instead of increasing the number of transactions. So that way, I think this query is also addressed. Now, one thing we noticed after this shift to quarterly rebalancing was that the minimum requirement of the investment amount has gone up to close to 4 lakhs now. And there have been existing investors who were earlier on a smaller investment amount. And while rebalancing, some of these have not been asked to top up the differential amount. So first is why the minimum requirement has gone up, and second, a related question is what such kind of investors should do, wherein the investment or the current portfolio amount is less than the minimum investment amount.
Yeah, I mean, first of all, why this minimum investment amount has gone up is because of a few stocks, right, which have made it into the portfolio. And essentially, these stocks have come in at a fairly low weight. Essentially, these are new ads. So, if you think about a very simple example, if you add a stock in a portfolio at say 50 bips weightage or a 50 bips allocation, and the stock has a stock price of 2,000 rupees, right? So one share is trading at 2,000 rupees. The weightage given to that the stock is 50 bips, right? So you need to have a portfolio of at least 4 lakhs, right, to buy one stock of that company, because we cannot buy less than one stock, remember, right? So that's the problem that happens, right? And because there are no fractional shares, you can buy, right? In India, there is no concept of a fractional shares yet. So we are left with this problem that, if a stock gets added to the portfolio, and because it's a new entry, it will come in at a low weightage. So, and given the construct in MeritorQ, right, where we don't take discretionary calls on stocks, right, as long as, it has cleared all our filters, and, it has passed our corporate governance check, and it's it has cleared everything, and it's undervalued, it's everything, it ticks all the boxes, we have to include it in the portfolio, right? So that's the problem, that it leads to, where you can see change in the minimum investment amount of the portfolio, right? Frankly, this is not something within our control. This is something again dictated by the strategy, right? But we do make efforts on our part to ensure that this doesn't cross, the jump is not too huge for investors. But again, we also need to be cognizant that we don't end up, excluding stocks randomly, or taking discretionary calls on a portfolio, and in the process harming the bigger interest of investors, which is to their returns or the risk-adjusted returns of the strategy. Right now, coming to what investors can do, I would suggest investors whose investment is less than the minimum the minimum investment amount suggested on small case to top up their investments whenever they have the necessary liquidity, and that can also be done in tranches. So it doesn't need to be like a lump sum investment or a lump sum top up. You can do it slowly over the next 3 months, or whatever suits you to get to that amount, right? And but remember that again, howsoever you do it, you should try to get as close as possible to the model allocations, right, which we have advised. So it's because it's not recommended for investors to first of all, you should rebalance, remember, to get full benefit of again whatever we are discussing today. And secondly, you should also ensure that your allocations, which you're holding, or the number of shares you're holding in your portfolio, it mirrors the advice that we are offering through small case.
Got it. So one question on the slide that you have on the screen. So you mentioned now we have moved to 33% large cap allocation, but we still have 67% portfolio allocation to mid and small caps. And as you mentioned, these have rallied considerably over the last 1 year. Do you think this portfolio can be further tilted towards the large caps and reduce the allocation towards, say, small and mid?
Well, I mean, like I said, right, so, it's a function of two things, right? So, one is your overall, market, valuations as such. And so, for example, in this quarter, if large caps do exceedingly well, right, relatively well, and they kind of catch up with your small and mid caps performance last year, then, we can never say, right, maybe the small and mid cap allocations might actually increase in the next rebalance, right? And also remember that we are picking or we're looking for undervalued stocks within the quality bucket, right? So we are not looking at, again, relative valuations, at a market level, right? That could be, for example, good quality, stocks within small caps, which are available still at throwaway valuations, right? Even, heading to the next rebalance. So there's no way for us to say, that, allocation towards small caps or mid caps will go down going forward. But if things stay where they are, what I can say is there is a good probability, there's a higher chance that large cap allocations still will still keep up, keep going up versus small and mid caps.
Okay, got it. There are a couple of questions on, like we have, say, 40 odd companies in the portfolio, and our horizon is, say, BSE 500 to start with. Uh, how uh, how would you perform corporate governance checks on such a large chunk of companies every quarter? So if you can quickly elaborate on the corporate governance check that we follow, it will help them understand.
Sure. So the corporate governance check is not performed on the 80 or 100 odd companies. It's performed on the final portfolio, right? What we do is the 80, 100 companies, they are checked for they go through the forensic screener which we have, which also includes a lot of indicators which we use, which someone can also call as a corporate governance check. For example, one of the ratios which we use is the remuneration paid to auditors versus the growth in the revenues of the company, right? So if the remuneration given to auditors is increasing at a faster rate than the growth in the revenues, then it obviously calls into question the objectivity of the auditor, right? Who is checking the books of the company, right? So that's, again, included in the forensic screener, which we already have. Now, this corporate governance check is at the very end, the very fag end, where we have the final portfolio, and there we are asking the entire Marcellus team to look at the portfolio and tell us if there are any companies, right, where there is a corporate governance issues which cannot be quantified, right? That could be innumerable number of issues, right? And also be things at a promoter level which did not reflect in the company's financials, right? So these are, again, we are talking about the major shareholder of the company, how they treat minority shareholders, whatnot. So essentially asking the our the team here bases their cumulative experience to to tell us if any of these companies are uninvestable from that the corporate governance perspective, and if they are, what we do is we just remove those companies and just redistribute the weights across the rest of the stocks. Until now, what we have seen is there have been three such cases till you know till last year. In the most recent rebalance portfolio, no stock was removed due to corporate governance check, right? So it's not necessary that you'll have to throw out stocks due to corporate governance check. It's only when you find that there are certain stocks which you made it through all the screens or all the all your checks, all your quantitative checks, that the corporate check or the corporate governance check comes into action.
Got it. And I believe our initial filters, basically the checklist will also determine the exits what we are making in the portfolio, because we are uh, running these filters every quarter, and if something doesn't fit into that filter, then automatically either the weightage would be reduced basis what comes out of that filter, or the stock will get exited irrespective of what share price it is trading at.
Yes, yes. But again, the corporate governance check is for cases where you have, again, essentially, any issue, corporate governance issue, which is unquantifiable, right? Like I said, issues at a board level or at a promoter level are things, which if they're serious enough, or for example, if the company is engaging in corruption, for example, right? When you'll not be able to see it, in a very straightforward way in a company's accounts, right? So in those cases, again, it becomes impossible to quantify this, as such. It might be passing all the checks. Though what we have seen is, in most cases, the company does fail the forensic check in the very first step itself. But in very odd cases, or very corner situations, you might still have a few companies still making it through, in which case obviously our corporate governance check takes care of those cases also.
Right. So one question is, suppose if somebody was to do a monthly top up or monthly SIP, then how will the allocation will be taken care of?
So the allocations within the monthly SIP is determined by small case. So I think they will be in a better position to answer. But from what I understand, the SIPs, the allocations within each SIP will be done in a way so that you're able to get as close as possible to your model portfolio allocations.
Okay, got it. One question is around, suppose the AUM of the strategy crosses a certain level, will liquidity be an issue? And in case we have any parameters to mitigate these kind of issues if they come up in future?
No, no, no. So this is not a problem within the advisory construct. It's because remember that all these stocks are residing in your demat account, in the investor's demat account. It's you're not we're not taking the money from you, right, as investors. So essentially, this is neither a mutual fund or neither is it a PMS where you have taken your money from you. The money is invested by you through your demat account, and the stocks are there in your demat account, right? And unless any of you yourself, in your personal capacity, have invested, say, more than, I don't know, a very large amount, like 10, 20 crores, right? And you're trading that kind of a portfolio, through your demat account, you should not see meaningful market impact just due to your trades, right? And remember that again, rebalancing is not done by everyone in all together, right? You're obviously, we are sending out the notification. We expect everyone to rebalance on the very first day, but some of the subscribers might do the rebalancing on the very first day. Some might do it at a different time or even different times during the day, right? So what this means is, the invested amount is that's just your the individual investors invested amount, which is which should not be a which should not cause a large market impact. And secondly, even if there is, right, you might someone might have invested say 50 lakhs or a crore. Even in that case, because again, all investors are rebalancing at different points in time, this should again not cause significant market impact. And also, remember again that even if if all these conditions are not met, because we have not moved to quarterly rebalancing, like we said, right, we are now splitting the turnover, or spreading out the turnover more smoothly over 4 quarters or 4 times a year. The requirement or even the market impact, even from a very large trade, that should not be a significant drag, at least now.
Right. So the next question now is on the churn itself. Sir is asking that the portfolio churn has not improved, it has increased. So maybe worth repeating once that what is the change in the churn, and whether it has any impact on the overall. It might have any impact on the overall trading charges as such.
Yeah. So when we say churn, essentially we're talking about the entries or exits in the portfolio, right? So the entries and the exits, at least basis our simulation, and we showed this on this slide. Again, I'm talking about the turnover number there. So per our simulation, the churn number is not very different if you go for semi-annual versus quarterly, and so the entries and exits, that doesn't change much, right? Because it's exactly the same strategy, nothing has changed, right? What does change is because now you are picking up undervalued stocks more often. Your position sizing to model weights every once in 4 quarters instead of every twice in a year. So that's why your the change, or the turnover due to the upweighting or downweighting, right, of individual stocks, or due to the change in the weightage, that's slightly higher for quarterly rebalance versus semi-annual rebalance, right? And that change is the differences between 58.8 versus 58.2, right? So 60 bips increase, which is someone might say it's nearly immaterial, right? And this is again, we looked at these numbers, and that's why again, and also given the benefits, like we said, for which justified this move to quarterly rebalancing. Overall, it just made sense for us to make this change.
Right. I think couple of last questions. One general question is, what is the parameter to decide difference between large cap and mid cap? Are we following the MP guidelines, or do we have any other guidelines to bifurcate?
So again, we have just used the companies which are part of the BSE 100, BSE 150, and BSE 250. This is broadly in line with the AMFI guidelines.
Okay. One question is, suppose there is a huge swing in the markets in between the quarterly rebalancing. Would we consider doing an immediate rebalance, or we will still stick to quarterly rebalancing?
We will still stick to quarterly rebalancing, right? And the reason is, I don't think for the reasons again we showed in this slide. Even if you look back at history, I don't think there's been a lot of instances where there has been a meaningful drawdown, where you'll not be able to pick up, or you'll not have the essentially the drawdown period lasting less than say 3 months, right? There could be, you can say there are still some instances, but the number of such instances should still be small. So, within 3 months or within a quarter, there's a high chance if there is a drawdown that you will be able to pick, stocks, at least along some portion of that drawdown, right? You'll still be able to pick undervalued stocks and then benefit whenever the recovery happens. Because remember, these are quality stocks, right? So, you'll definitely not suffer, as high as a drawdown as the whole market, right? So your downside is protected in that ways. And also remember that these are again, undervalued. So, whenever the recovery happens, the recovery will happen faster for, these kind of stocks than for the whole market, right? So you get the benefit of, not just having your downside protected, but also a faster recovery. So, like we have highlighted, that's one of the benefits of picking up undervalued quality companies here in America.
Right. Next question is, so do you expect the FCF yield to go down in the subsequent rebalances, which means higher undervaluation, and which probably will imply expectation of higher returns in future?
Uh, again, like I said, right, a free cash flow yield is a function of both your market valuations and also the valuation within the quality stocks, right? So depending on how that moves, yes, free cash flow yield can go up or down. I don't have a view of where free cash flow yield of the portfolio might look like in the next quarter, but I'm absolutely sure it will be higher than that of the market, right? Because that's one of the key objectives of MeritorQ, which is to pick up undervalued stocks. So your free cash flow yield, which is the reverse of price to free cash flow, should be higher than that of a equal weighted BSE 500 universe, right? Which is what we have seen till date, and which is what I expect to continue. Now, whether free cash flow, higher free cash flow yield implies higher return, generally that's what we have seen. But remember that extent of undervaluation doesn't guarantee, again, an immediate reversion or, much higher future returns, right? Reversion could happen or it could take time, right? Firstly. And secondly, depending on the kind of stocks you have, sometimes, the future returns might be underwhelming versus the extent of, say, their undervaluation, right? That could be due to different reasons, right? So yes, I would expect generally if the stock is trading, if your portfolio has a much higher, free cash flow yield, i.e., you have more undervalued stocks to generate higher future returns generally, but there's no guarantee that more undervalued portfolios should lead to great returns in the future.
Yeah, thanks. This is helpful. So that was the last question for the evening. If you have any closing comments, you can share those. Otherwise, we can close the webinar.
So, like I said, we have made this change, keeping the best interests of investors in mind. I hope all of you, whoever has not subscribed, subscribe to this on small case. And if you have subscribed already, please go ahead and rebalance if you have not done it already. And if you're facing any issues with, for example, any of the, steps in rebalancing, or if you have any questions, again, our team is here to help you. So please reach out.
Thanks, Krishnan. So just to reiterate, for investors who are looking to subscribe to this portfolio, it's very easy. You just need an existing trading and demat account. You go to Marcellus advisory page, marcellus.in/meritor-advisory, and you can choose the fee structure that you want to invest in. Very simple few steps. You can start with as low as 4 lakhs currently, which is the minimum investment amount here. In case you have any queries related to the product, you can reach out to us on help.ia@marcellus.in. Or if you face any execution related difficulty, you can write to help@smallcase.com. So with this, we come to the close of today's webinar. We hope this session was helpful. Thank you all for attending this session, and have a great evening. Thank you, Krishnan.
Thank you.